I, Pratichi Avinash, Marketing Manager, R&M India, welcome you all to the webinar on emerging market investment destinations. We have eminent speakers with us today who have a wide experience in their respective fields. Looking forward, I am definite that today's session will bring in deep insights in terms of emerging market investment destinations and will be fruitful for each one of us. Today, we will be discussing about contemporary focus areas such as cross-border investments, Gift City and its regulations around investments and gift funds, China Plus One strategies, and more. I'm greatly thankful to the participants joining in and hold heartfelt gratitude to the eminent speakers. I request everyone for your active participation throughout the webinar. If you have any questions, kindly put them in the Q&A section, which will be taken up by the experts towards the end of the session. Moving ahead, I request the R&M India chairman, Mr. UN Marva sir, to kindly give the welcome address. Over to you, sir.
Thank you, Pratichi. A very warm welcome to all the participants who are joining today in the webinar organized by R&M India. We are thrilled to have such a diverse group of individuals gathered here to explore the exciting opportunities for investing in the emerging markets of India, China, and Hong Kong. R&M India is a consulting firm operating in Delhi since 1946, spanning 3 generations, and having branch offices in Gurgaon, Bangalore, Mumbai, Raipur, and London. Every business seeks growth, expanding to cross borders. The more business friendly and adaptive the new destination, the easier it is to set up a successful business. India has several industrial zones, and recently the development of Gift City is viewed as an added advantage in providing a thriving financial ecosystem, which is critical to support and expand businesses. Hong Kong is and has been an ideal place for investment. It is a business-friendly and numerous advantages that ensure businesses flourish. China is home to about 1/5 of the world's population and has a rapidly expanding economy. Today we shall talk about cross-border investments, China, strategy of global firms, Gift City, and its regulations around NRI investments in gift funds, and much more. I would now like to introduce the esteemed panel for today's session. Mr. Thomas Wang is a well-renowned co-founding partner of CW CPAs, which is an international mid-sized professional accounting and advisory firm based in Hong Kong. He looks after the business development and strategies of the firm, and his agenda has always been developing overseas markets. He established a Latin American and Spanish business advisory unit in 2006, which is truly developed, serving the Spanish and Portuguese speaking clients. Riding on the wave of technology, Thomas has become a fervent believer in the power of digitization. He has created his own ecosystem of business partners that provide resources to startups that possess the potential to drive growth in our society. His persistence in working closely with technology partners, including Hong Kong Science and Technology Park, Cyberport, Zero, Air Wallets in Kingdee, etc., has become an essential strategy in guiding his professional practice into a new era. Welcome, Thomas. We have Harm Hunstra. Harm is a senior manager at MSA and part of the corporate services team based in Shanghai. He specializes in company structuring and operational advisory in the early stages of companies entering China. The advisory on the optimal method of market entry, location search, and assessment of specific local requirements require the licenses to operate in China. Pawan Shah is currently the General Manager of the International Financial Services Centres Authority, Gandhinagar, Gujarat. Prior to this, he had experience working with SEBI and working with Tata Consulting Services. Pawan has dealt with policy development and enforcement of regulations concerning primary market, corporate restructuring, and policy framework for mutual funds in India. He's a gold medalist in business administration, a chartered financial analyst, completed financial risk manager, FRM. We have with us Saloni, who works as a fund manager at Phillip Capital, Mumbai, and has an overall experience of 18 years in investment research in fund management. She is successful in identifying themes and stocks that have provided multiplier returns. She's worked as the Vice President of the State Bank of India, the largest bank in India, with a peak equity portfolio of 16.8 million. She's currently a CFA and postgraduate in finance from top-tier business schools in India. Lastly, I would like to introduce our moderator, Raghu Marva, the Managing Partner and CEO of R&M India. Upon becoming a qualified chartered accountant, he joined the R&M team, having gained experience at the Big Four. He has an experience of more than 20 years, specializing in advising and structuring businesses abroad for Indian corporates, building India's entry strategies for foreign clients, cross-border holdings, merger and acquisition, and all. He oversees the consulting practice of the firm. With this note, I will now request all the members to come on, and I hand over the mic to Raghu for opening the session.
Thank you so much, and welcome everybody to another exciting webinar on emerging market investment destinations. Today we're going to be talking about 3 destinations: Hong Kong, Shanghai, and the Gift City in Gujarat, as you heard. And we're going to hear the secret investment strategies from a successful fund manager as well. So we've got a lot to do going forward, and without much ado, I'd like to open with Mr. Thomas Wong. Good afternoon, Mr. Thomas Wong.
Good afternoon, Raghu.
So my question to you, Mr. Wong, is Hong Kong being an important global financial center in Asia, how easy is it for Hong Kong-based asset managers, family office managers, and investors looking to make cross-border investments in India and all over the world? Over to you, Mr. Wong.
Thank you very much, Raghu. First of all, I would like to say something. I'd like to thank very much, for R&M, for partnering with my firm, CWCPA, and your firm, R&M, was referred to me by the Indian consulate in Hong Kong, to which I'm very thankful and grateful. And I hope you know that in days to come, I will continue and will be to be the value-added super connector between Hong Kong, India, and China. And Raghu, just now the question you asked, actually I have prepared a few points which I would like to share with the audience today. But before sharing the few points with the audience today, let me introduce myself to all the audience, to all the people who have attended this webinar. Now, business is about, first mover. India is a thriving economy now, the 5th largest GDP in the world right now, and it will continue to grow. It will continue to grow. If we do not do business with India, this important market, we will lose a lot of opportunities in days to come. This is me as a 64-year-old guy, my gut feeling, my sense of observing how India is so important in days to come. Now, my firm, CWCP, as what Mr. Raghu Senior just now mentioned, it's an international firm. We have offices definitely in China, in Shenzhen, Guangzhou, Shanghai. Hong Kong is the headquarters. We have liaison office in London. We have liaison office in Barcelona, Spain. We have liaison office in Bogota, Colombia, and also Brazil, Belo Horizonte, and Sao Paulo. So having said that, I do not have a liaison office in India, but I have RNM, which RNM will be my Indian desk in days to come. Definitely, for sure. Now, in this world, you do not need to have really a physical office. What you need is someone you trust, someone that you can rely upon, and we can do everything online, So this is how I want to share with all the people. And in that regard, I have, just now, Raghu, you asked me the question, I have prepared a summary, and I would like to make a summary first in 4 points that I would like to mention. Hong Kong, why Hong Kong is so important, why China is so important. Hong Kong is a city of China, we all know that. But Hong Kong, has been for so many years as the financial center, and it will continue to be, for my motherland. And in days to come, not only as a financial center, but also as an IT center, but also as a wealth management center and an IT hub. Now, so in that regard, I have prepared a few points, for the audience to hear. Number one is Hong Kong. We have a very strong financial relationship, with many overseas markets, including India. And then secondly, my second point will be we have a robust financial infrastructure. And then the third point, we have expertise like me in the wealth management. And then lastly, the fourth point is we have a deep pool of capital in Hong Kong. That means many investors, many venture capital funds, So that's why I am extremely busy recently, because a lot of overseas company wanted to come to China via Hong Kong, which I can share with everyone, listening to this webinar. I have now 45 inquiries. They are all from overseas, including UAE, including one from India, So they all wanted to go to China and then to do business with China via Hong Kong. So the 4 points that I mentioned just now, the strong financial relationship, with India. A lot of people don't know that Hong Kong, we have signed a double tax agreement, avoidance agreement. We call it a double taxation avoidance agreement. We signed in 2018, is to prevent double taxation of income for residents of both countries. It promotes economic cooperation and cross-border investment. We promote economic cooperation. So you can feel it, everyone can feel it. I am now cooperating my firm, CWCP, a Chinese firm in Hong Kong, doing business, cooperating with an Indian firm, called RNM, in India. So this is something that we should look forward. And of course, bearing in mind this double tax avoidance scheme, and this is very technical. Of course, we know how to handle this sort of question, from would-be investors from India that they want to invest in Hong Kong or in China, or vice versa. China wanted to build up factories, in India via Hong Kong to go up. Normally now I'm helping a lot of Chinese mainland companies to going out strategy. So I think India is a very good target. I would say a very good entry point, for China, because we are very renowned. Both India and China are very renowned in manufacturing. So this is something that we have to look carefully. And of course, a lot of mainland Chinese companies, they want to go to India. They want to find a middleman like me as a Chinese. They trust me as a Chinese. But overseas Indian people, they trust me as a Chinese to go into China. And in fact, a lot of people do not know that I have many Indian friends in Hong Kong. And India is a city where we have many foreigners, including India, including UK, including USA, many from overseas, and of course India. So this is the double tax agreement I want to mention. The second point I want to mention is the robust financial infrastructure. We have a very well-regulated market, including the Hong Kong Stock Exchange, including, as I'm as an accountant, so we have the Hong Kong Institute of Certified Public Accountant, and of course we have CPA Australia, and via this CPA Australia, I now managed to have an intern in banker law. I'm promoting bilateral education, not only bilateral trade or bilateral business, but I'm promoting bilateral education. I would use the word use, the student in Bangalore, I use him, to write programs for me. Bangalore is very good in writing programs. A lot of people in Hong Kong don't know that. And then apart from the Hong Kong Stock Exchange, the Hong Kong Institute of Certified Public Accountant, and the CPA Australia, we have a very sound financial infrastructure based on, the what we call the common law that we are now using, like India is using, so we are relatively the same. So there is basically no difference if I deal with, Indian businessmen, because we are under the same law, common law. Okay, and then the third point is expertise in wealth management. That is what I would like to say, because now a lot of people are getting richer and richer. The middle income class in China, yes, they would like to invest, in products, or perhaps, in overseas investments, like investing even in a factory, or even, in products like insurance products. So we have a very good wealth management team in Hong Kong, and I can see that now recently there are many banks in Hong Kong, like HSBC or Citibank or whatever bank you name it, they have a wealth management team. So this is very important. And also we are now, Hong Kong, we are promoting family offices, so we invite, people from India to come to Hong Kong to set up their family office. Now, so this is maybe very new to India, maybe yes, but business is about first mover. Of course, my firm, we can give the explanation, and then we can give advice to overseas people, investors who are interested in set up family offices in Hong Kong. And then talking about the infrastructure, not just only family office, not just only the banks. We have many big insurance players in Hong Kong, like AIA, like Prudential, or like Manulife. They each insurance company, they have their wealth management products, and a lot of buyers, they want to buy this sort of products because they want not only protection for their health, but they also want to make some money, save money.
Yes,
Save
course.
money,
I think, like the people from India, people from Hong Kong are very astute with money, very astute with math. And I think with those kind words, thank you so much, Mr. Wong. It reminds me of something that Charlie Munger, the great investor, had once said, that more important than the will to win is the will to prepare. So as long as the preparation is good and we've got good advisors and good planning, I think we can all and our clients and investors can really win. So with that,
yeah, I like your word astute. Indian people and Chinese people are very, very astute, not only in numbers, but also in the way of life. In other words, not only astute, but we have wisdom, in the way of life, how to handle life. This is very important. Accounting, we know, very easy, no problem. You just find a trusted accountant like RNM or like CWCP, trusted. Everyone knows it. So why we are here together? Because of the Indian consulate refer you to me, and that's it.
Absolutely. Thank you so much, Mr. Wong. With that, I'm going to switch gears to Harm Hunstra. Hi, Harm. My question to you is, what is the best way for global companies making investment in China plus one strategy to set up in China as well as in other countries in Asia, such as India? I think the world has gone in for a big change post-COVID. There's a lot of China 1+1. So over to you, Harm, for your response. Thank you.
Yes, thank you, Raghu, for the introduction and your question, and thank you for having me on the webinar. Just as a quick introduction, so my name is Harm Hoenstra. I'm a senior manager at MSA in China. I'm based in Shanghai. What we specialize in is supporting foreign companies in China with both like entering the market as well as with their accounting and financial needs. And as such, like we are part of the GGI network, and that's how we are in touch with RNM. So yeah, the question for the China plus one strategy, that is of course been a pretty hot topic already for many years. I guess that around 10 years ago or so, it was coined for the first time, where companies and countries realized that there was slightly an over dependence on China. Because China plays such a key role in supply chains globally, especially considering that China is the only country in the world that basically has all the industries available in the world. So it's always been a very important destination on the back of the low costs back in the day. But yeah, of course, what we have seen over time is that this low cost advantage has definitely decreased by a lot. And also what we then have seen is both with COVID as well as with the trade tensions with the US, that more and more countries and companies have been looking at an alternative to China. I think that what many companies have found is that it's very difficult to completely move away from China in its entirety, just because of the sheer base of like highly skilled workers, the strong supply chain infrastructure, and all the likes. In China, it has proven difficult for companies to move away fully from China, but companies have been very much exploring the option of moving part of their operations away. So we as a company, we help the Benelux Chamber in China with their annual survey, where we basically ask companies from the Benelux, Netherlands, and from Belgium, Netherlands, and Luxembourg if they're considering moving some of their operations away from China to somewhere else in Asia. And especially in the last 2 years, we've seen that almost like a third is at the very least considering this idea. And there we have seen that like at least like 1/3 of them are actually considering India as an interesting destination for their operations. So we're really seeing like Vietnam, Malaysia, Thailand, and India as key destinations for companies to move their operations from China away from. And I think that India, of course, offers a very large base, a large population base with over, I don't know if they've already overtaken China or not yet, but if not, then probably soon. So a very large base of potential employees, as well as a high proficiency in English, which has really proven as a strong option for many companies to move there. Now, when it comes to making that work, it's of course very important for companies to choose the right partner in this plus one. So which country, where many countries have their own advantages in different kind of industries. What we have also seen from our survey is that really in like manufacturing businesses that are also really looking at India. So I can imagine IT, healthcare, and the likes that would be very much moving into the direction of India. So when it comes to how to structure that for your Chinese entity, that is always kind of a tricky part. I'm sure that everybody has heard before that China is restricted in money flowing in and out of the country. So that is also something that we help a lot of our clients with, is that if you don't have it structured well, it's difficult to move your money in and out of the country. So also when it comes to that aspect, so like for companies that are already in China, if they do make the decision to set up part of the operations in another market like India, it's difficult to have the Chinese entity in the group invest directly into a foreign company, because the government will not just simply let you transfer the funds out of the country. So you will need to receive approval up front in order to do so. So usually what we see many of our clients do more is to have the Chinese operations and the operations in another market more exist like sister companies compared to a mother-daughter company. So either a headquarter that will do it, or like an Asia Pacific base, such as a Singapore or Hong Kong. We see very commonly that those kind of entities would be holding both of the entities in the group where they are working together. So that is definitely a very important consideration for companies to take into account, like what is going to be the structure, and indeed like investing into each other, not always easy. So yeah, also in that sense, when you're going to be doing these kind of operations, it's important to work out that when there's going to be traffic either between goods or money or people between China and another market, it's important to work out like how would that work, especially from a money flow perspective. And because China, of course, they have a number of industries that are also restricted in operation. So it's important to work out whether your industry is fully free, even though it has been opening up a lot over the past couple of years. And then to work out like how can we move funds back and forth. I understand that what happens a lot is that like we also see China Plus One is being used to circumvent the tariffs from the US. That, you know, a last step of assembly would happen in a place like India, just to make sure that there's no longer this made in China stamp on the product to get around that. So what we see is that still quite some of the activities are being done in China, but that at least part either in assembly or for some like lower value parts are being moved to other markets. So when there is going to be the flow of goods and funds, it's important to work out how can you make sure that payments can be made properly. We have seen Chinese companies always experience that they always indicate it's difficult to make payments abroad, perhaps that they're also not used to that. But if you make sure that you work together with the right kind of partners, you can work out a way to make sure that you can send your money abroad. Also, when it comes to if you're having actual operations locally in China and you're making also profits in the market that you would like to repatriate to India or another market, it's important to work out your profit repatriation strategy, where you could be using things such as dividends, but also items such as service fees, management fees, or royalties, where as long as you make sure that you have paid the respective withholding taxes and you can show, hey, I've paid the right kind of taxes, it's my money now, then you can actually send it out. So it is really important for a company to really take all of that into account. And that is also something that we're seeing these days. Companies are more careful about going ahead with China and other investments. First, work out, really have a good plan, some market research before actually diving into fully going for one of these strategies.
Absolutely. Thank you so much, Harm. I think, like you said, the multidisciplinary areas that one has to look at today, not only of China, but like you said, the neighboring countries, Thailand, Vietnam, India, that's very important. And that reminds me something of what Marcel Proust once said, that the real voyage of discovery consists not in seeing new sights, but in looking with new eyes. So I think with your great words, I think we're having to look at India and China Plus One with new eyes. So thanks so much for that. With that, I'm going to just shift gears and welcome Mr. Pawan Shah, who is based out of Gift City, like was said earlier. Welcome, Mr. Shah. My question to you is, how are the regulations formulated by the IFSCA and the infrastructure set up by Gift Company Limited ready to deliver on making Gujarat International Finance and Tech City a major international financial center? And in that regard, just as a follow-up, could you focus on some of the new regulations around facilitating NRI investments in gift funds? Over to you, Pawanji.
Sure. Thank you so much, Mr. Raghu, for inviting me and for this conversation. So the question that you asked to me has 3-4 facets in it, right? So I'll try to address each one of those. And to start with, let's understand the need first of a Gujarat International Finance Tech City, and especially the International Financial Service Center, which is housed within the GIFT City. So if you look at India as a geography, right, we are faced with two specific problems. One, on the capital side, the capital that flows into India and out of India, there are certain restrictions on it, right? We are still not a freely convertible jurisdiction, and there are domestic requirements which lead to such a situation. At the same point of time, if you look at the domestic market, which is largely meant for retail investors, so a lot of the rules of the domestic regulators of the banking regulator RBI and the securities market regulator SEBI are largely governed around protection of investors or the consumers, right? And because of which the domestic regulators in some form or manner are constrained to liberalize the regulations. A lot of times you face difficulty in onboarding investors, ease of doing business, and all of it, right? Host of challenges for investing into the Indian markets otherwise, and then taking money out as well. It was with this twin problem in mind, the government had envisaged the GIFT IFSC, which is for all practical purpose outside of the FEMA regulation. So capital controls otherwise which applies to India does not apply to GIFT as a jurisdiction. And secondly, in terms of our regulations, because largely, by and large, this will be institutional business, this will be a business by sophisticated investors. A lot of our regulations are made from that perspective. If you look at IFSCA as a regulator, we are the only unified regulator in India, right? When I say unified regulator, we are armed with powers under 13 different central acts. So we regulate the banking, insurance, capital markets, and pension fund business in the GIFT IFSC. In addition to this traditional areas, any new financial product which can be envisaged, which may not be seen from the traditional lens of a financial market activity in the domestic market, can also be regulated in this area by the IFSCA. And the classic example has been of setting up of an international bullion exchange, the first of its kind spot exchange in GIFT IFSC, right? So in terms of the regulations that you asked, so what has happened, and practically for us, it has been a journey of about 3.5 years now since we have been set up. The first 18 months, I would say, were the formative years where we were looking at what kind of regulations we want. And the next 18 months have been towards, as in increasing more awareness about regulations, fine-tuning those regulations, getting into standard supervision practices and all of it. And during this 3.5 years, what we have done is we have issued about 30 plus regulations and framework governing not just the traditional areas of banking, insurance, capital markets, and pension, but also new and emerging areas like aircraft leasing, ship leasing, fintech, and a lot of other areas as well. When we do any new piece of regulations, 3-4 things which we essentially take care of is, one is surely ease of doing business. It remains the central piece of our regulation making process. If you look at our regulations, as in, just to take one example of the fund management regulations, right? The business with government setting up of funds and investing into India. It's a single piece of regulations governing institutional funds, often we call them as alternative investment funds, the retail funds, often known as the mutual funds, portfolio management services, REIT, InvIT, all of it, investment advisory as well. So it's a single piece of regulation, and once an entity is registered as with the regulator, they can undertake a host of fund management activities, most of it with no intimation then, because in any case, the entity is registered and regulated by us. Some of it with a simple intimation, and only for a few things where you will be touching smaller or the retail investors, you need again a prior approval of the regulator. Again, in terms of ease of doing business, what we are doing is we do understand a lot of businesses would be set up in GIFT, which will have touch points in different geographies, right? They may not be self-contained within the GIFT jurisdiction. So at least for businesses which are set up in GIFT for investments into India and other geographies, we are trying to develop a single window clearance. You make a single application with the IFSCA, and our single, as in the text system which will be deployed by next month, will talk to RBI, will talk to SEBI and other regulators. We are trying to engage into passporting arrangements with a lot of other regulators. So that is on ease of doing business. Separately, a lot of times we are told, as in the financial center space, we have been as in probably a late entrant, right? We just started 3-4 years back. But the beautiful thing about this late entry is we can see how the world has progressed over a period of time. We can see how financial centers have progressed, what mistakes they've made, what good things they've done. And we can inculcate all of it into regulations, make it ease, not just as in for established entities, even for new set of entities who otherwise would not have been financially regulated entities in other jurisdictions. And the third piece is to be a center where innovations is also respected, right? A lot of times regulators are averse to innovations otherwise. As a regulator of a budding financial center, what we have is for each of our regulations, we promote regulatory sandboxes. We promote setting up of businesses in innovation sandbox as well. If there are some things which come in the way in terms of the regulations, each entity, if there are genuine cases and if it is more to do with market development, we are more open to relook at the regulations. Any regulations which we issue, before that we do a large public consultation process, and actually the draft of the law is put up on our website for public comments as well. So that was on regulations. In terms of the business development over a period of time, so it has been, like I mentioned, about 3.5 years of journey, where the initial part was on developing the regulations and issuing them, and the later part of creating more awareness around it. And if you look at how businesses have evolved in the last 3-4 years, so now we have got about 26 banks, out of which more than 11 are foreign banks. Together in last 3 years, they have developed a business of about $60 billion, as in that's the asset size. In terms of transactions, it has crossed about $800 billion. In terms of funds, practically in such a short period of time, we have more than 120 asset managers who have come here and set up their operations. And amongst all of them, they have set up about 130 funds as well, together targeting about a corpus of about $33 billion as well. So that's the kind of business in banks, fund side. Similar numbers are there on the insurance, fintech, and other areas as well. Coming to your last question on the NRI piece, right? So if you look at the Indian diaspora overseas, we have one of the largest diaspora. As per a MEA estimate, we have about 32 million Indians living overseas. And in terms of the inward remittances into India from our diaspora, right? Again, we are one of the largest, as in remittances of from our diaspora, which as in based on 2023 numbers, the inward remittances were about $125 million, right? A lot of this money are remitted towards maybe hospitalization, towards fixed deposits, towards education, a lot of other things. And the investment portion at this point of time is small. But the way, as in the wealth of Indian diaspora, which has been increasing manifold, right? A lot of it is expected to be channelized towards investment. Even in the domestic market, where the share of investments into capital market was less than 2% before probably 7-8 years, has grown manifold, right? In the last 5-7 years. Same way we would expect this inward remittances would go into a lot of investments. Mr. Thomas, in his opening remarks, highlighted about the future of India, right? We are the 5th largest, soon to be 3rd largest. By 2047, we have a roadmap to be a developed nation as well. Same way, he also elucidated towards a lot of Chinese investments through Hong Kong, right? So a lot of Indian diaspora would like to invest into India with the simplified structures, with a lot of ease and all of it. For years together, under the SEBI FPI regulations, when the funds are set up outside of India, there was a restriction that 50% of the investments as in those funds cannot be by NRIs, OCIs, and residents put together, right? And when we say overseas citizens of India, technically they are not even Indian citizens as well. So we are clubbing them as well. So essentially what we are saying is, if there are large Indian as in HNI investors staying overseas, willing to cut a check of $100 million, we are forcing asset managers to get an equal amount of check from the non-residents as well, right? From the other foreign nationals as well. And not to start investing unless they get those checks. We are making their life miserable. And we can think of complicated scenarios in case of an open-ended fund, right? Investors may move out. Then large funds with high level of compliance would like to have the Indian diaspora in their funds. So amongst all the regulators between us, SEBI, RBI, we felt there is a strong need to ease out these norms. So what we have in place, which is available only with respect to GIFT IFSC, funds in IFSC GIFT can accept 100% of the money from NRI OCI investors. This is for the first time, which will be allowed for investments into India. Separately, even as far as if you look at otherwise the requirements of obtaining a tax number for investing into the domestic market, right? A PAN is mandatory, and people are not averse to paying taxes, but they are somehow averse to getting into the ambit, right? So what we have done for this geography now, it's a very simplified tax structure where the fund will pay a tax at the fund level itself. There are certain advantages as well. And for the investors, including of the Indian diaspora, if they don't have any other taxable income in India for which they are required to file returns in India, they need not have a PAN in GIFT IFSC for investing into funds. So those are some of the initiatives through which we are trying to get more investments into India from our diaspora.
Thank you so much, Pawanji. I think very, very bold initiatives. Like you said, some of the initiatives for the first time, very welcome. I just want to ask Harm before we move to the next speaker. Harm, do you think, Shanghai being, again, a great financial center in this part of the world, and Thomas, also for you, like you talked about Hong Kong's legacy of being an awesome financial center. Some of the things that Pawan said regarding being a single window clearance, having powers of multiple organizations and authorities being enshrined in one. Do you think that this is something that already some Chinese cities or other Hong Kong have already adopted? Is it something that we have maybe leapfrogged ahead on and taken on some of the best things from other jurisdictions? Just wanted to get your reaction, Harm, to some of the things that Pawanji just mentioned.
Yeah. You want me to answer this question?
Yes, Thomas, I think you can go next after Harm. So we'll let Harm.
Okay, I'll go after Harm. Okay, Harm, you do first.
Thank you.
All right. Yeah, so when I think when it comes to China, it's of course a very different situation because everything is really quite restricted from a government perspective, that money is not allowed to move freely cross border. But we are seeing some policies being tested, more like pilot phases in the Greater Bay Area, where really between Shenzhen, Guangzhou, and Hong Kong, that they are testing out methods to let money flow more freely across borders. And yeah, perhaps that is also something that Thomas could shed still some light on, also from a Hong Kong perspective, for some more free movement there. Because yeah, of course, China and Shanghai, Hong Kong, still important financial centers, and there's still some work to be done for the +1 countries to get to that level. But I think there's definitely potential there to also become important.
Thank you. Over to you, Thomas.
Yes, thank you, Raghu. Talking about Hong Kong as a financial center, definitely for sure, because in terms of the renminbi, the currency of China, over 70% of the renminbi, flow, is in Hong Kong. Okay, so a lot of companies in China use Hong Kong for the payment overseas. That's why they have all the currency renminbi here in Hong Kong. And basing on the comment just now made by Harm, Shanghai is always a place you should not neglect, because most of the big companies are already in Shanghai. The infrastructure is there, but what is lacking, is now how to push these companies, be it whether they are from China in Shanghai, Chinese companies in Shanghai, to think of the international concept. The international concept is use Hong Kong as a base, as a conduit, as a super connector to go to India. We do not mind that, Hong Kong is playing a middle role, but definitely, the image, will enhance, because we are connecting not only overseas companies via Hong Kong to China, but now also Chinese companies via Hong Kong to overseas market, including India. So never write off Shanghai. Of course, we should not write off Hong Kong. That's my answer after Harm. I have been to Shanghai recently. I have an office there. Most of my clients are overseas clients that they still use my accounting services in China. And the story goes on and on. It's not bad. The situation is not bad.
Thank you so much, Thomas. So just to conclude what Pawanji said, great words of advice for us, but it reminds me of what Satya Nadella once said, that the true scarce commodity of the near future will be human attention. So I think, there's so much information coming from everywhere. At some point, we need to focus. We need to try and that's the big challenge of the next generation as well. So with that, I'm going to shift to Saloni Kapadia, who's our last speaker, but not the least in terms of the speaker topic. So Saloni, hi. What are the investment strategies over the next 7 to 10 years which are likely to make investing very profitable for investors globally in the Indian market? And if you could add some points to what Pawanji said in terms of, if we can put the cherry on the pie by using some of the tax as well as the single window ease of doing businesses of GIFT, hopefully the next 7 to 10 years will be even brighter. So over to you in terms of your thoughts on that, Saloni.
Yes, so the attention spam is a difficult thing for me right now. Yes, so I like Pawan Shah already shared that you don't need to you don't need a PAN card, and you don't need opening a bank account in India. So that makes somebody sitting outside India very easily, seamlessly invest into Indian markets. So even if getting a PAN card, even if they want to, they have to travel all the way to India, etc. So it saves just ease of doing and getting business done. And now coming to what I am going to share about why would you invest in India and what are the strategies, etc. So I'll start with India is the fastest growing economy, which grew at 7.8% this year. And the world grew at 3.2% and China grew at 5.2%. So during a phase where the world was finding it difficult to record growth, in the last 3 years, India has recorded 7% plus growth. And this reasons for this top tier growth is reforms and policy initiatives like GST and e-way bills were introduced, and they saw the formalization of the Indian economy. I am going to share some remarkable achievements in the space of infrastructure and digitalization. So our broadband subscribers in India grew 10-folds. The digital in 10 years. The digital transaction volumes in 5 years from 2018 grew 6.5 times. Number of bank accounts tripled. In 10 years, solar and renewable energy grew 5 times. National highways grew by 65%. So this is what has happened in the past. Now, what is ahead for us? So in the first year, I would like to say in the next 2 years, all rating agencies, be it S&P Global, World Bank, Fitch, all of them have given around 7% growth target for the next 2 years. So if this progress continues, this 7% continues, we will be able to achieve our target of 5 trillion GDP. So that is 2 years. We are talking about 7 to 10 years. Now, what is it that is going to take it to the next level of growth? I will compare it with China. So India is there in the world GDP is 3.3% and China is 18%. And the services part has already significantly, it is similar to China, the significant, even overtaken China, the services part through IT and global capability centers and data centers. So the growth has to come from manufacturing, as mentioned earlier by Harm and Thomas. So this growth is manufacturing and trade. So we have seen the government going for GST in 2017, going for corporate tax cuts in September 2019, PLI in incentives, all in the area of manufacturing because it creates jobs. Because manufacturing creates a maximum jobs compared to services, and there's over underemployment in agriculture. So coming back, I think one of India, somebody mentioned some of the interesting facts between India and China. India's economic size is the number 5 in the world, but it is 1/5 of China. And as somebody, I think India has already overtaken in terms of population China, and we are at our average a young age of 28, 29, medium age. And our fertility rate is higher than, is almost slightly declined compared to the replacement rate. So in the next 2 decades, the working age population is there. And this could lead to a demographic dividend, which is demographic dividend, and would create, as long as we are able to create jobs, the consumption and the growth story will continue. India has election results tomorrow and exit results out. So we have a stable government. We are expected to have a stable government, which is focused on growth development. Last week, S&P Global re-rated India from neutral, from stable to positive. Another interesting factor, which I think was not mentioned, is the domestic institutional investors. The flow has, from last 4 months, foreign institutional investors have taken out $10 billion outside Indian markets, but the domestic inflows have been of $18 billion. So the support is coming from domestic investors and mainly via domestic mutual funds. Mutual funds, monthly, they are getting $2 billion monthly SIP inflows. So SIP is systematic investment plan, is more sticky in nature. And if you see the folio of the mutual fund, it is 90% towards retail investor. So this is the kind of investors who give resilience to your market in times of global crisis. Also, coming to the foreign institutional investors, they are very underweight India. So they are at 16% and the peak was that they were at 22%. So they will also have the fear of missing out, FOMO, and they will also return when we have a stable government back to their Indian markets. In bond segment also, India has added to the emerging market index. JP Morgan added it. So there could be some flows. Now, I will say, how do we play this? How do we know all India growth story? Now, what is it that we would want to invest in? So I suggest a fund between debt and equity. My higher weightage towards equity, given the high growth scenario in Indian markets. I would recommend being overweight on large cap, equal weight in mid cap, and selectively choosing small cap. This is subject to the risk profile of the investor. So the reason for this is large cap is trading at around 17.5 times and mid caps is trading at 26 times. So the risk return ratio is more favorable towards the large cap. We have to identify companies which are have visible growth and a strong return on equity, sustainable return on equity ratios. And now I have identified themes we can play for the next 7 to 10 years. So the first theme, I think everybody's talking about it, is manufacturing-led economy. I've also mentioned it. We have taken the production-linked incentive scheme. So now India has moved from Make in India, that we'll make for ourselves, to becoming a global manufacturing hub. This is their target. And they have taken steps towards that. They have introduced a PLI scheme for the same. And to support that, they have taken infrastructure support through Gati Shakti scheme. They have taken ease of doing business through the single window scheme. So together, PLI can be game changing. So last year in November, they reported 746 applications and an investment of 9.5 billion rupees already. So we know the story of mobile phones. PLI is very given a 54% growth in 2022 in the mobile phone business. Mobile phone export business and 133% in 2023. And at the same time, your imports declined by 33% and 4%. And this you can see in China's numbers, their exports have reduced by 17% and 3%. And the 17% was in the year, in a very favorable base year. It was after COVID 2022. So we can see that if we make that effort, there can be a dent. And now, what I would like to share is that there is huge potential. In trade, we are less than 2% of the world trade, So this and we are 8 times, China is 8 times the export trades compared to India. So even a slight dent in China's export can be huge for Indian players. And this gives us a huge opportunity to make money as an Indian investor because of our small base. Our second theme is infrastructure. Central government is pushing towards investment-led GDP in roads, defense, railways, renewable energy. Budget allocation for road is increased by 29%, union budget allocation, 26% for railways, 10% for defense. Third point, India defense indigenization. So we are looking to grow the export spending by 10%. We're also looking to support import substitution. And we've made reduce the procurement timelines, improve the negotiation process so that the private players can get into the defense sector also. There are some significant deals that have been signed, and there has also been a transfer of technology from the foreign OEMs to especially in the aerospace space. So that gives a huge opportunity. My fourth point is really combining everything else. So the government is nudging for private sector CapEx, capital expenditure, because we are at 74% capital utilization. We have healthy balance sheets. The corporate India is not as leveraged as before. The banks are having a healthy balance sheet to support the growth, and there is positive demand outlook. So now combining these 4 large themes, we can look to invest in capital goods and engineering, EMS, electronic manufacturing and services, metals, especially pipes, cements. So this is on the manufacturing side. Now I'll come to, when you talk about the highest population, young population, we have to talk about consumption. So India is in its villages, so there is expectancy of rural demand revival, which will boost income. And now what has happened is, your rural India is connected to digital platforms via UPI. The infrastructure, road, they have electricity, reliable electricity. So that makes them a good, gives them the chance for higher consumption. And with the employment coming in from the manufacturing infrastructure, etc., they become a good customer base for us. Middle class in India is growing at 6%, and it comprises of 30% of the population. Now I have to compare it with China. We are, the per capita income is at 2,700 approximately, and China is, I think, $13,130 per person. So as the per capita increases, per capita income of India, there is scope for growth, and it increases, there will be a demand for consumer discretionary items. The aspiration population is increasing, so that will give rise. Some examples which already is mentioned is wealth management. So earlier in India, nobody would pay money to manage money, this thing, manage funds, etc. Then there is insurance. In India, we look at insurance as a savings product, not as a protection plan. So then there is retail, that is malls, etc., businesses that will be thriving. So some examples I've given of discretionary income. My last one is a more global theme, which is IT sector. So India, NASSCOM has said India has $254 billion size of the IT sector. Within that, 200 billion gets exported, which is around 60%, 58% of the global outsourcing demand. So the size is huge. currently, if you see the management commentary and the growths are coming at close to 2-3%. So, and earlier they have average I have counted as 9, I calculated as 9%. So there is a scope for demand. There is a scope for mean reversal in the next 5 to 7 years period. So that can be a large opportunity. How do we play this IT sector? We go for mid caps because they have lower base, so you can grow further. They work on a nimble foot. They can be more flexible. And look for companies which are in the high growth area where they can grow in the digitalization in finance space, healthcare. Look for cloud migration. There is also companies which India IT companies are seeing growing relevance in global ER&DA space, especially in automotive and airspace business. So there is some of the sectors we can look at in IT. So these are my large themes for investment.
Thank you so much, Saloni. I think that was all so awesome. And this reminds me, 5 words that separate the good from the great is flawless execution of the fundamentals. So I think we're all talking about the fundamentals, the fundamental strength, the fundamental balance sheets, and how the investor should approach it. It's been, so awesome hearing about, so many different topics we've covered during this 1 hour, from China to Hong Kong to Gift City and now investment strategies. I think it'd be great. In case there are any queries and Q&A from anybody, any of the panelists have any questions that anybody would like to ask. My only thoughts are that, I think just go, like Nike says, just go do it, because I think there's so much to be done and so little time, I think, to achieve and grasp your dreams and aspirations. I think it's, it's a great time to do that, whether it's through various structures that the government is helping enable, or through, cross-border trade, like Thomas said, relationships, trust, friendship, those are the key things. I'm going to pause. Pawanji, any questions, queries for the other panelists? Any thoughts you would like to share at this point?
I'm fine, thank you. Mr. Thomas has one.
Yes, Raghu, I have a question for you, for the panelists, or you being the moderator, So which city in India now is the most densely populated with the Chinese investment in terms of factories? Which city is the most densely populated in India?
Well, that's a tough question. My guess, if I were to fathom a guess, would be, I think, maybe Gujarat. Gujarat is a state on the west, and there's a lot happening over there in terms of investment going into that state around manufacturing. There's a lot of tech happening, of course, in Bangalore. Artificial intelligence is one theme that we didn't touch upon, but that is obviously becoming extremely important from the IT point of view. So there's some great AI development that is happening, which is jointly happening with a lot of global companies. But yeah, I think...
So it's in the West, right? So this is the question I deliberately asked, is that if we continue this sort of webinar, we should think of the next topic, because a lot of Chinese now are going out. If it is to the west of India, what sort of incentive the west of India can give to the Chinese manufacturers?
Yes.
This is no, you don't have to answer today. This is something that I just want to put into your brain. And then, because also you mentioned we are astute, we have wisdom, so this is why I love to work with Indian people. We are people with wisdom.
Absolutely. Thank you so much. And with that, I'm going to just close by quoting again Charlie Munger, one of my favorite investors, who said that the best thing a human being can do is to help another human being know more. So I hope through this webinar, all of you have learned and now know more. And with those kind words, I want to thank everybody for their patience, their kindness, and for attending. Thank you so much. All the best and Shabba Khair.
Thank you, everyone.
Thank you.